Ever thought about trading like the pros, maybe? But felt like, I don't know, the rules were holding you back. Well, listen up, because there's a really big shift brewing in retail trading. It could fundamentally change who gets access to the markets. So today, our mission is to really get into the proposed changes for the pattern day trader rule, the PDT rule. We want to unpack what it means for individual investors, people like you. And we've dug into some great sources for this: Investors Observer, TradingView News, and an interesting piece called The Future of Day Trading, lowering the PDT threshold, trying to get you the full picture here.
Yeah, and the headline change, it's pretty stark. FINRA, that's the Financial Industry Regulatory Authority, they're seriously considering slashing the minimum account balance you need for frequent trading, taking it from $25,000, which is quite a chunk of change,
Right.
all the way down to potentially just $2,000.
Wow. Okay. $2,000. That's a huge difference. So let's back up a sec. This PDT rule, it's been around a while. Can you remind everyone exactly what it did? Why was it such a barrier for lots of traders?
Absolutely. So the PDT rule came into effect way back in 2001. And basically it said if you made 4 or more day trades.
So buying and selling the same thing in one day.
Exactly. 4 or more of those within 5 business days. And you did that using margin, borrowed money. And your account balance was under $25,000, then bang, you got flagged as a pattern day trader. And that meant restrictions. You might be limited to only trading with the cash you actually had, or even blocked from making new margin trades for 90 days.
Ouch.
Yeah. And the original idea, the stated purpose, was investor protection, to stop novice traders especially from getting wiped out by using too much leverage.
Makes sense for 2001, maybe? But, rules designed for one time often feel restrictive later. Why the big push now? What's driving this?
Well, what's really fascinating is you've got major brokerages like Robinhood, Charles Schwab pushing this. Their argument is pretty simple. The rule's just outdated. Think about it. 2001, commissions were high. Someone calculated an average day trader needed like $200,000 in gains a year just to break even back then.
Wow, okay. Different world.
Totally different. Now you've got zero commissions, fractional shares. The whole landscape is transformed. Anthony Denier from Liebel Financial, he put it pretty bluntly, said the rule came from a time when retail investors just didn't have the same access to information as the pros.
Right.
Plus, brokers argue their tech is way better now. They can monitor risk in real time much more effectively, so maybe they don't need that big $25,000 cushion across the board.
Okay, so the argument is it's outdated tech-wise, information-wise, cost-wise. But, some might say, sure, the tools are better, but the actual risk of losing your shirt day trading on margin, that hasn't fundamentally changed, has it? What's the pushback?
That's exactly the counterargument. Access is one thing, but the inherent volatility, the speed, the leverage, day trading on margin is risky, full stop. So the pushback really centers on that original idea, investor protection. Is lowering the barrier just going to lure in more folks who aren't prepared for the potential losses, regardless of fancy apps?
Okay, this is where it gets really interesting then. If this threshold does drop to, say, $2,000, what happens next? Could we really see, millions more people suddenly day trading? What would that do to the market?
Well, it's not just about more traders, so that's part of it. It could change how certain assets trade. Think about smaller, maybe less liquid stocks. They could become sort of new playgrounds for really rapid trading by lots of small accounts acting together, almost like micro swarms moving prices.
Micro swarms.
Yeah, maybe not just the big whales moving things anymore. It could definitely ramp up intraday volatility. And yeah, you might see echoes of that meme stock craziness from 2020, 2021.
Okay, meme stocks. That definitely gets attention. But let's connect this back to the risk side, because it sounds potentially dangerous too. Proponents talk access, sure. But critics, like Haxiang Zhu, a finance professor at MIT, they warn this is fundamentally risky stuff. There's data, right?
Yeah.
A recent Stanford study, 2024, I think, found that more market access often hurts retail investor returns.
That's right. And the international picture isn't pretty either. Regulators in India found, 91% of retail investors lost money trading equity derivatives.
91%.
Yeah. And in Germany, they looked at their turbo traders. Basically, their high-frequency retail folks, 74% lost money.
Wow.
It seems the market.
Well, it has a way of teaching humility, doesn't it?
It certainly does. So given those numbers, if this rule changes and potentially millions more traders can use margin, what does responsible broker oversight even mean? How do brokers handle that?
That is the absolute key question here.
Yeah.
Brokers would get a lot more discretion under this proposal.
Yeah.
And they'd have to walk this really fine line between, opening doors and letting people take opportunities versus protecting clients from, frankly, blowing up their accounts. It's a tough balance.
A very tough balance. Okay, so this is all still proposed. What's the timeline? When might we actually see this happen, if it does? Well, it's apparently in the final stages at FINRA. After that, it needs the nod from the SEC, the Securities and Exchange Commission. If it clears all those hurdles, implementation might start rolling out maybe late 2025, possibly early 2026. So not immediate, but definitely on the horizon. It really is a significant potential shift. It can redefine who gets to actively trade in the markets.
Definitely. So wrapping this up, what does it all mean for you listening right now? As these rules potentially shift, think about this. What does responsible broker oversight truly look like in this faster, potentially more accessible trading world? And maybe more personally, how might this change your own approach to risk and deciding how you participate in the market, if at all? Something to mull over.